How is it that Canada, once a nation celebrated for its middle-class homeowners, now finds itself grappling with a housing affordability crisis of such magnitude? Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. Let's get right to it. According to the Demographia International Housing Affordability 2025 report, released by the Urban Reform Institute and the Frontier Centre for Public Policy, all of Canada's 6 major housing markets are rated as unaffordable. The report utilizes the median multiple, the ratio of median house prices to gross median household income, to assess housing affordability. A ratio of 3.0 or below is considered affordable. Yet Canada's national median multiple now stands at 5.4, placing the country in the severely unaffordable category. The report highlights that Vancouver, with a median multiple of 11.8, ranks as the 4th least affordable market globally, trailing only Hong Kong, Sydney, and San Jose. Toronto follows with a median multiple of 8.4, while Montreal sits at 5.8, both categorized as severely unaffordable. Calgary and Ottawa-Gatineau are labeled as seriously unaffordable, with multiples of 4.8 and 5.0, respectively. Edmonton, with a median multiple of 3.7, is the most affordable of the 6 markets surveyed, albeit still moderately unaffordable. The report draws a strong correlation between housing unaffordability and restrictive land use policies, such as greenbelts and urban growth boundaries, particularly in British Columbia and Ontario. Wendell Cox, the report's author, states, "What was once a nation of middle-class homeowners is becoming a country where homeownership is out of reach for the average family. The evidence points to a direct link between these policies and rising housing prices." Interestingly, the report notes a spillover effect. As prices climb in Vancouver and Toronto, affordability in smaller regional centers like London and Guelph is also deteriorating. This trend, termed counter-urbanization, is driven by migration from unaffordable urban cores. From 2019 to 2023, Canada's largest metro areas saw a net loss of nearly 275,000 domestic migrants, while smaller markets gained population. The report concludes that densification alone will not solve the crisis. Canada needs more housing where people want to live, including detached homes at the urban fringe. While the challenges are significant, this situation could present opportunities for investors in multifamily real estate, particularly in emerging markets that are seeing population growth as a result of this counter-urbanization trend. Let's shift gears and talk about the recent trends in Canadian real estate prices. According to Daniel Wong's article published on May 15, 2025, Canadian real estate prices have continued to decline. The Canadian Real Estate Association's data indicates that the composite benchmark price for a typical home fell by 0.7% in April, landing at $701,900. This marks a 3.6% decline from the previous year. It's interesting to note that these prices have remained within a relatively narrow range over recent months, with the typical home price now comparable to levels seen back in 2021. The article further explains that annual price growth for benchmark homes across Canada has been decelerating, according to the Canadian Real Estate Association's Home Price Index. The 3.6% contraction last month was the 4th consecutive month of decline, and it's the sharpest annual change since September 2024. Despite cheaper financing and more leverage available to buyers, the market is experiencing what is known as a triple top, where prices have peaked 3 times since the all-time high in March 2022, each time at a lower level than before. This indicates that buyers are increasingly rejecting price increases. Wong's article points out that while some may attribute this trend to trade war jitters, the issue is more complex. Affordability and perceived value are becoming significant concerns, particularly in Canada's most expensive cities, such as Toronto. These cities have seen considerable price corrections, yet it's uncertain if these reductions are sufficient to attract buyers who once flocked to these areas for unique opportunities and low unemployment rates. Now these cities are struggling to compete with more affordable regions that are drawing top talent away. While this might paint a challenging picture for some, it's crucial to look for the opportunities that lie within these market dynamics. For multifamily real estate investors, particularly in regions experiencing population growth due to affordability shifts, this could present lucrative opportunities. Areas like Hamilton, Kitchener-Waterloo, and Niagara might just be the next hotspots for investment, as they offer more value and potential for growth. As always, it's important to approach these market trends with a strategic mindset, considering both the challenges and the potential opportunities. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.